most technology startups scale and they need kind of tranches of capital infusion as they grow and get bigger and bigger. And at this early stage, in today's episode, we are going to discuss how to get a loan for a business startup. And welcome to another exciting episode of TopStartups, the podcast where we teach first-time entrepreneurs how to think like a lawyer and investor during their journey. I am your host, David Nima. I am one of the top trademark and technology attorneys in the United States. I've been practicing since 2007. I'm also the author of the books, TopStartups and Top Trademarks, that are designed for first-time entrepreneurs to gain working knowledge of best practices in connection with their branding and in connection with their tech startup launch. In today's episode, we are going to discuss how to get a loan for a business startup. Getting a loan for a business startup is one of the most critical components of early stage company formation and organization, so that you can go about building your prototype, doing your initial marketing, and getting your first customers and getting to profit. You need cash in the business. It's very important to have cash in the business. Now, there are different ways of capitalizing a technology startup, okay? Capitalizing or infusing capital, more specifically financial capital or cash, into a technology startup. Now, we're going to talk about that a little bit later in this episode. We're going to be talking about things like equity deals, for example, or crowdfunding, or even getting an advance from your customers. But first, let's talk about how to get a business loan or to get a loan for your startup. A couple of key components that you want to think about when you're going about and doing loan shopping, so to speak, for your business startup. One of the first things you want to think about is the principal amount of money that you want to borrow. And then in addition, you want to think about some kind of specific clauses in typical loan agreements, such as, for example, an acceleration clause, which may come into effect depending on the terms of the loans that have been negotiated. So those are some of the terms of a loan agreement for a business technology startup that you want to consider going into the lending phase of your business, and if you're deciding whether a loan is right for you. Question then becomes, where you can get a loan, a business loan from. So one of the first places that you can certainly look for a loan is a bank. Most banks are in business to give loans, and if you have collateral or you have a relationship with that bank, in some other way you are a worthy borrower, the bank is going to be more than happy to provide you a loan for your startup business. Some of the loan terms that I discussed earlier still apply, especially the principal amount and the interest rate, but the bank is certainly one suitable place to get a business loan. Another source of business loans for technology startups is wealthy, high net worth individuals. Okay, these can also be sometimes angel investors or some other type of high net worth individual who's got the money to lend out into a business, more specifically a technology startup business. Loans provide a very tremendous advantage to businesses because they don't require the business to give up any control or equity in the business in consideration for the infusion of capital. All the business has to do is repay the loan. You don't have to negotiate terms such as stock ownership, voting rights, preferred stock, and common stock. None of those kind of equity negotiations come into play when you're doing a straight loan type of deal. Now let's talk a little bit about the alternative sources of capital that are available to technology startups. One of the first and most popular sources of capital to technology startups is what's called an equity deal. An equity deal is a deal in which you get an infusion of capital in exchange for a portion of the ownership of the company to the person or investor who's investing the capital into the company. Okay? Here, the investor will purchase shares of the company's stock through something called, for example, a restricted stock purchase agreement. And these agreements often require the company to go through a valuation and essentially negotiate based on a perceived value of each share in the company, because certainly you're going to be exchanging various shares in the company for actual currency and cash coming into the company. So you need to have a determined valuation if you want to do an equity deal. Another way of getting initial capital into a new business or startup, besides loans and besides equity deals, is by getting an advance from early customers. This could be an advance, for example, from a large enterprise customer that is interested in your product and is willing to write you a check before you have actually delivered the product. Another way of getting an advance from customers, let's say on the consumer side, would be through a crowdfunding campaign that would be strictly donor-based crowdfunding. And all you're doing in exchange for that initial capital is promising them certain things on the crowdfunding page, such as early access to the product or maybe an early version of the prototype. Either way, you're getting an advance of capital into the business without going through a loan, without doing equity. And here, the risk here is that you're now contractually obligated to deliver on whatever it is that you said you're going to deliver in exchange for the advance, whether it's to an enterprise customer or it's to the consumer class of customers. Either way, you're going to be on the hook for contract terms, and if you violate or you fail to deliver, you may be in what's called breach of contract. So in conclusion, capitalization is a very important component of tech startup businesses. We discussed loans, and I think loans are certainly suitable for technology startup businesses. The equity financing is another good option for technology startup businesses. And then you got things like crowdfunding and getting an advance from early stage customers, which can be one of the best ways of financing an early stage venture. Either way, no matter which source of capital you decide on, most technology startups scale and they need kind of tranches of capital infusion as they grow and get bigger and bigger. And at this early stage, you really want to focus on what is going to be that kind of base amount of seed funding that you will need for your startup, and then have a trajectory in looking ahead 2 years, 4 years, in terms of what would be the later rounds of financing that your company may need based on its growth and scaling trajectory. There's a chance that it may not need any additional financing because all of the revenues will cover expenses and then allow the company to grow. But most startups raise capital in tranches because once they validate the product and they have that initial traction, they're going to want to scale fast, and those early revenues, if there are any for a technology startup, which in some cases there may not be, those early revenues are not going to be enough to capitalize or fund all the growth and scaling that they want to do. And that's why they go through later stages of financing. And in each case, each time that you're doing financing, you're bringing in new capital, these are the types of capital sources that are available to you. There are loans, there's equity, there's other alternative sources such as getting an advance. So that's been a little bit about how to get a startup loan for technology business startups. I am your host, David Nima, author of the books Tip Top Trademarks and Tip Top Startups, and I look forward to seeing you guys on the next video.